So on average, luxury homes in Sonoma County are sitting over 200 days on the market and selling at 88% of list price. Meanwhile, mid-range properties are still selling at close to 99% of their asking price and selling in 55 days. So I'm exposing which price points and towns offer real leverage right now. So here's what's actually worth buying today. But before we dive into the details of where to buy, let's look at what's changed in the first place, because that shift explains everything that follows. So let's kick this off with the biggest story of 2025, which is the inventory surge, which flipped the whole seller-buyer dynamic on its head. The numbers paint a clear picture. Active listings jumped to over 700 homes, a massive 56% increase from the same time last year. And homes are sitting longer too. 55 days on average, up from 33 days in 2024. And here's the kicker. Homes are closing below asking price on average, and that's not happened for quite a while. That's beyond a tweak in the market. That's a full-on shift from sellers calling the shots to a market that finally feels a lot more balanced. Think back a few years. People writing offers sight unseen and throwing out contingencies simply to compete. Today, total opposite. Buyers have got breathing room. And don't get me wrong, there are still some types of properties that are still attracting multiple offers. In fact, this week alone, I've submitted a couple of offers, both of them competitive. Please say we got both of them, but those competitive situations still do exist for those homes that check all of the boxes. But in general, buyers have got breathing room. They can book inspections, negotiate on both price and terms, and really ask themselves if a home fits their long-term plans before making an offer. From where I sit, tracking these numbers every week, it's an important shift and an important rebalancing of the market. Months of supply, which means how long it would take to sell all current inventory if nothing new came on, is now at just over 3, which is definitely not a total buyer's market, but it's also not a total seller's market. So it's much more balanced. And remember this shift, it explains why leverage looks one way in the mid-range market and a very different way in the luxury market when we get there. But here's what makes it interesting. Not every price point is moving the same way. Some segments are shifting faster than others, and the patterns in buyer behavior definitely aren't uniform. It's almost a little bit of a schizophrenic market. All right, let's dive into where the real opportunities are showing up. And the first sweet spot is hiding in plain sight. It's a mid-range single-family home, which I would say is between 800 and 1.2 million. So make sure you subscribe so you don't miss the next updates. I'm on the ground in Sonoma County, walking through properties, talking with sellers, meeting buyers every day, and bringing the real story behind the numbers. If you want the kind of local insight that saves you time and money, this is definitely the channel for it. So now let's talk about that 800 to 1.2 million range, because this is where I see the best balance of value and opportunity in 2025. And here's why. This price band has exploded with new listings. Inventory is up over 64% in this segment, under $2 million compared to last year. Yet, despite that surge in supply, median prices have held steady around 800 and 845,000. And that's unusual, and it tells us something important. The homes that are priced correctly in this range still move in 30 to 55 days, which is pretty healthy given today's market. But the absorption rate, and that's the share of homes selling each month, has slipped from 60% to 36%. It means that buyers have got more choice, and that means only 36% of all homes are selling each month. So it means that buyers have got more choice and more leverage than they've had in years. And that leverage is real. For the first time in a long time, buyers don't have to rush. They can slow down, tour multiple homes, negotiate terms that actually work for them. Take a recent example. A 3-bedroom home in Santa Rosa sat on the market for 62 days. It started at $950, ultimately sold for $875 with repair credits included. And the buyer was able to keep full contingencies and negotiate a fair timeline, something that just wouldn't have been possible only a year ago. What makes this segment so attractive is the mix of buyers it draws. You've got families looking for primary homes and second home buyers chasing wine country escapes. That steady demand combined with more inventory means strong fundamentals and real negotiating power. And if you're looking in this range, I recommend zeroing in on properties that have been sitting for, say, 60 days or more. That's where sellers start feeling the pressure. They've watched other listings move and don't want to be the one left behind. That's when you can often shave 5, 6, 7, 8% off the asking price and have contingencies that you're comfortable working with. But the mid-range story is only half of the battle, because if you step into the luxury segment, the dynamics are completely different. If you're eyeing a luxury property in Sonoma County, 2025 has opened the door to negotiating power we've not seen in years. Let's look at the numbers. Luxury homes are taking an average of 82 to 92 days on the market compared to the faster movement in previous years. And some listings are hanging out at 200 plus days before they find a buyer. An absorption rate in the over 2 million market is down to 8%. That's just 8% of homes selling each month. Put another way, fewer than 1 of every 12 luxury listings sells every month. That kind of slowdown gives serious leverage to buyers who know how to play it. And we're about to break down which towns are holding firm and which ones are correcting next, so do stick with me. I mean, I've worked plenty of high-end deals in this county, and I can tell you, this is a sea change. During the pandemic and shortly after, $1 million plus properties were magnets for multiple offers, often with no contingencies. And that wasn't just $1 million properties, that was $2 million properties, up to $3 million properties were getting multiple offers, which is just crazy. Now you can walk into these transactions, be patient, be prepared, and be in control. Overpriced luxury homes are selling around 85–88% of their original list price once they finally close. I mean, that's hundreds of thousands of dollars left on the table for sellers, and a huge opportunity for the right buyer. But not every discounted luxury home is worth chasing. The smart plays come down to 4 things: location, property condition, unique features, and killer views, and any future development upside. Miss one of these and you could be overpaying, even with a price reduction. And just as important as the price point is where you're shopping. Some pockets of Sonoma County are definitely showing resilience, while others are seeing sharper corrections. And this is where the story really splits, because Sonoma isn't one market, it's 2 very different ones depending on where you look. So let's break this down. One of the most fascinating shifts right now is how uneven the market looks from town to town. We're not dealing with one single Sonoma County market anymore. It's split into 2 very different stories. On one side, you've got lifestyle-driven markets like Sonoma and Sebastopol. Those places are holding pretty strong, even growing. Sonoma prices are up nearly double digits year over year, while Sebastopol shows solid growth at 7.7% appreciation despite the wider market cooling. So why? People want the walkable downtowns, the art scenes, the farm-to-table restaurants, the wine country lifestyle. Demand for that experience isn't slowing down. On the other side, you've got commuter-heavy markets like Santa Rosa and Petaluma, and they're definitely softening. Santa Rosa prices have dipped 1.5% year over year, while Petaluma has seen an 8.7% decline. These areas lean more on local jobs and day-to-day practicality, which makes them more sensitive to interest rates and economic jitters compared to people who are looking for the wine country lifestyle, which is more based on disposable income. By the way, in a few minutes, I'll turn this split into step-by-step moves for first-time, move-up, and investor buyers. You don't want to miss it. And then there are the rural properties, especially around Healdsburg. That's where the buyer mix looks really different. About 75% of sales in rural Healdsburg are going to second homes or investment buyers, with only about a quarter going to full-time residents. And here's the part that people miss. It's not San Francisco buyers driving this. The most active group picking up second homes and picking up properties in these areas like Healdsburg, they're actually people who live in Sonoma County, people who already live here. That shows the level of confidence in the market that outsiders sometimes underestimate. So what does this split mean? I mean, if you're a primary buyer looking for value, commuter towns like Santa Rosa, Petaluma give you much more leverage and more house for your money. If you're chasing lifestyle, places like Sonoma, Healdsburg, and Sebastopol are still worth paying up for because the long-term demand is so strong. And if you're investing, rural properties with vacation rental potential are also where the numbers still pencil out best. To make it even clearer, picture a map. Inside Healdsburg city limits, about half of all sales are primary residences. Step outside to the countryside, that number drops to 25%. I mean, it's a sharp reminder of how much people prize Healdsburg's rural homes. It's a sharp reminder of how much people prize Healdsburg, but also the difference between rural Healdsburg and Healdsburg city limits for second homes and retreats. Now let's turn that map into a strategy guide and break it down buyer by buyer. So given everything we've covered, how do you actually take advantage of this market? Let's break it down by buyer type. If you're a first-time buyer, the sweet spot is listings that have been sitting 60 days or longer in Santa Rosa and Petaluma, especially if they've already taken a price cut. These sellers know the market's changed and they're usually more open to negotiation. Look at homes that were originally overpriced by 10–15%. That's where you can often come in 5, 8, 10% below today's asking price and still get the inspection and financing contingents that you need to make sure you've got a safe deal. The best way to do this is be systematic. Start pinpointing neighborhoods that balance affordability with livability. Places like Montgomery Village in Santa Rosa or Western Roanoke Park or East Petaluma. Then filter for the homes that hit the 60-day mark and at least one price reduction. From there, compare against recent sales, not the original listing price. That's how you uncover the real deals. Now, if you're a move-up buyer, this is a rare window. You can use today's market to trade commuter area home for a lifestyle market upgrade. Say moving from Petaluma to Sebastopol without as much of a financial stretch as before. The spread between mid-range homes of 80 to 1.2 and luxury sort of 1.5 1.5 and above 2 million has definitely widened. Mid-range homes have held steady, while luxury properties have definitely seen corrections. And that creates a chance to move up at the best ratio that we've seen in years. And here's what it looks like in practice. Prep your current home so it shows well. Light upgrades, staging, sharp pricing, get it sold efficiently. Then focus on the luxury listings that have sat for over 90 days. Those sellers are often open to deals 15-20% below the original list price, plus the flexibility of timelines and credits. And that's how you leverage the gap between segments to your advantage. For investors, the play is different. Right now, 1 to 3 bedroom homes in zones eligible for short-term rentals, they're especially strong. With the updated short-term rental regulations, properties outside the cap and exclusion areas are golden. You want something that can cash flow in the off-season while still appreciating long-term. And we're seeing a lot of demand in that sector right now. And here's a real-world example. A 2-bedroom cottage near the Russian River listed for $850,000 with 25% down, all in monthly costs of around $4,800. In peak season, it brings in $7,500–8,000 a month. Even off-season, it's over $5,000 a month. So after management and maintenance, you're still running a small positive cash flow, plus strong appreciation potential, as well as the tax perks that go with it. And speaking of tax perks, savvy investors are turning to cost segregation studies and their bonus depreciation rules that have recently changed with the One Big Beautiful Bill, which reinstated 100% bonus depreciation, so you can deduct the full cost of eligible components in year one. On a $1.5 million property, that could mean $270,000 or more in tax savings in year one alone. I mean, that's like trimming 18% off your net purchase price. For luxury buyers, the strategy is patience, plus precision. Track specific properties that fit your wish list. Watch for price cuts or long days on market, even listing agent changes. Those are signs of seller flexibility. When you strike, negotiate not only on price, but also terms, extended closings, repairs, credits, with absorption rates at 8% in the luxury tier, you've got leverage, so definitely use it. So what's the bottom line? This market rewards buyers who know how to time their moves and structure their offers. But pricing strategy, whether you're buying or selling, still makes or breaks the outcome. And that brings us to the next piece, pricing precision. Let's talk pricing, because this is where so many deals are won or lost in 2025. I mean, the data's clear. Homes priced right from the start sell in about 55 days and close at roughly 99% of asking. And that's still a pretty good market. I mean, it's still pretty well balanced and strong. But here's what happens when sellers get greedy. Overpriced homes sat on the market an average of over 200 days. That's 7 months of carrying costs, constant showings, and mounting frustration. And in the end, those homes sold for 88–89% of the original asking price after significant price cuts. That's leaving serious money on the table. Hold on to those stats. They set up why the current timing window is so unusual, and more on that in a minute. I mean, I've reviewed hundreds of local transactions, and the same pattern plays out every time. Price it right up front, and buyers will respond. You'll typically land offers within 5% of asking and wrap it up within under 2 months. Overprice it, and the listing goes stale. Even after price reduction, buyers remember it as that house that sat and then come in low. I mean, there's so many times I get asked, oh, what's wrong with this house? And there's actually nothing wrong with it. It was just priced too high to start with. I mean, you never see good agents pricing homes too high. They'll price them at an appropriate price to get an offer within 30 days. And by doing that in a market that is a tough market and potentially going down, they get the best price. The psychology is fascinating. When a property first hits the MLS, it gets maximum eyeballs. That's when motivated buyers and their agents are most engaged. If the price feels right, you'll spark competition or at least some urgency. If it's too high, buyers mentally file it away as unrealistic. Even when the price eventually drops, that early momentum is gone and it rarely comes back. That's why precise pricing matters more than ever in this environment. If you get the pricing wrong in a rising market, it sort of doesn't matter because the market will bid it up to where it should be. You just can't afford to test the market anymore. The buyers who are active today are savvy. They're watching days on market and studying comps in the same way that agents are. Miss the market launch and you risk both losing time and money. Now, timing plays a big role too, and right now buyers have more leverage than any point in recent years. And here's why this moment represents such a unique window of opportunity. I get asked all the time about about timing. When's the right time to make a move? And honestly, right now is one of the best buy windows we've seen in years. Inventories surged 57% year over year. More than half of all sales are closing below asking price. That combination doesn't last forever. It's temporary, and buyers who understand it can lock in value that others will miss. And here's what history tells us. When sellers adjust to the new normal and inventory starts to thin, the balance resets. The leverage buyers enjoy today will fade and prices will stabilize again. So this transitional stretch is where the real opportunities are. And think of it this way. We're in a moment of inefficiency. Sellers are still pricing based on yesterday's expectations, while buyers now have more options and more time. That mismatch creates openings if you're patient and strategic about both the properties and the offers that you make. To make the most of it, tailor your approach by property type. For example, in mid-range hunt down the listings that have been on the market for 60 days or more. Start negotiations 5 to 8% under asking. Build in full inspection contingencies. Ask for credits and repairs. Sellers in this position usually want resolution more than a drawn-out fight. For luxury homes, focus on those at over 90 days. Begin offers at 10-15% below the original list price. And then build in the contingencies you need. And even longer escrows if that helps you sell your own property. These are big-ticket properties with motivated sellers, so use that to your advantage. I mean, it used to be a case that making an offer with a sale contingency was a non-starter. But in this market, it's definitely possible as long as you're realistic about what you'll get for the property you're selling. For investment properties, zero in on locations with strong rental history, but also consider the short-term vacation rental market, because there's huge advantages for investing in that space right now. Look for homes with expansion or improvement potential. Run the cash flow numbers with both rental income and the tax benefits, which are quite considerable. That's where the wins are hiding in plain sight. And here's what's remarkable. This isn't a distressed market. We're not seeing panic selling or foreclosure waves. What we're watching is a gradual reset after years of extremes. That's healthier for everyone, and it rewards buyers and investors who pay attention to the details. So what does all this mean for the bigger picture? Well, let's pull it together with a clear takeaway. So here's the big picture for 2025. Sonoma County is offering buyers more choice than we've seen in years, with inventory rising and prices holding steady in the mid-range. That combination creates a window for smart buyers and making strategic moves. The shift away from a seller-controlled frenzy to a balanced market means real opportunity across the board. And mid-range homes are holding strong while giving buyers more breathing room. When it comes to luxury properties, they're showing serious negotiation potential with discounts that were unthinkable not that long ago. And let's be clear, this isn't a crash. It's just an adjustment, a normalization. After several years of red-hot activity, the market's leveling out a little bit. That's good for buyers, but it's also good for sellers and good for the long-term health of Sonoma County real estate. For buyers, the key takeaway is leverage. You've got time to think, time to compare and negotiate, something buyers couldn't dream of during the pandemic and the following years. This is your chance to make a decision based on strategy, not being rushed into something. For sellers, the message is simple. Adapt. Pricing has to be sharp. Presentation has to be professional. And patience matters. Listen to your agent. Don't price it as if it was 2 years ago. The market's moved on. Homes that hit the market realistically still sell well. But the days of tossing out an aspirational number and collecting multiple offers overnight are behind us. Well, at least for now. From my perspective, this is a healthy reset. Sonoma County's fundamentals, the quality of life, the natural beauty, the limited land for development, and proximity to major job centres remain rock solid. That's why I expect stability through 2025 and the potential for appreciation as we move into 2026 and beyond. So if you're thinking about buying or selling here in Sonoma County, I'd love to help you with your next move. Shoot me an email at david@BruingtonHargreaves.com and let's talk through your goals. I'll help you build a clear, strategic plan tailored to this market. Whether it's your first home, your forever home, or an investment in wine country, the right decisions start with the right conversation. And if you found this market update helpful, please go ahead and subscribe. I share regular insights and strategies to help you make confident decisions here in wine country. And before you go, check out my next video right here, and it's the 5 areas in Sonoma County that will boom over the next 10 years. I'll walk you through the neighborhoods and communities with the biggest upside, backed by real data and development trends. You won't want to miss it. Go well, and I'll see you in the next video.